With some stocks, the hype can be absolutely deafening. So today, we're going to tune all of that out and do a classic Buffett-style checkup on ARM Holdings. We're going to ignore the headlines and focus on what the numbers are really telling us. And right away, you can see why everyone is talking. Year to date, ARM stock has just surged an incredible 114%. I mean, a performance like that doesn't just make headlines, it creates a massive storm of hype. But hey, as any smart investor knows, a soaring stock price doesn't even come close to telling the whole story. So our fundamental question is this: is the business itself as strong as its stock chart makes it seem? Let's find out. All right, so we've structured this like a 5-part investigation. We're going to look for clues in its business quality, check out its financial foundation, and see if the growth story is real. Then we'll get to the big one, the price tag, before we deliver our final verdict. Let's get started. Okay, our first clue on the trail is all about business quality. To put it simply, is this company actually good at turning a dollar into more dollars? We're going to start by looking at its core profitability. And to do that, we're going to use a metric that value investors love, return on invested capital, or ROIC. It basically measures how efficiently a company uses all its money from both owners and lenders to generate profit. In short, it's a direct test of how skilled the management really is. And ARM's ROIC comes in at a very healthy 14.02%. For value investors, really any number in the double digits is the mark of a high-quality, well-run business. So on our first clue, ARM is looking very, very strong. And this right here, this illustrates why it's so profitable. That gross profit margin is over 97%, which is just astonishing. It means that for every single dollar of revenue, it costs them less than 3 cents to deliver their product. This points to an incredibly powerful business model, what Buffett would call a wide economic moat, a huge competitive advantage. So, the business is profitable. Great. But how solid is its financial foundation? A great business can be totally undone by a shaky balance sheet, so this is a really critical check. The answer is a big, beautiful 0. ARM's debt-to-equity ratio is 0 because it operates with no debt. It isn't propped up by borrowed money, which makes it incredibly resilient. This is another very strong signal for a value investor. Okay, so we have a quality, debt-free business, but a high stock price demands growth. Our third clue investigates just that. Is the growth story that's fueling all this hype actually real? Well, the revenue numbers tell a compelling story. Growth over the last 12 months is a strong 26%. But even more impressive is the 3-year compound annual growth rate of over 63%. This isn't just growth. We're talking about rapid, sustained expansion. But here's a little twist in our investigation. While sales are booming, the net income, the actual bottom line profit, dipped slightly over the last year. Now, it's a small number for sure, but it's a crucial detail that a thorough detective wouldn't miss. It might suggest that costs are rising, or maybe investments are being made that just haven't paid off yet. And that brings us to the final and most important part of our investigation. We've established it's a great company, but what is the price tag? Does the price you pay reflect the value you actually get? This famous quote from Warren Buffett perfectly frames this final clue. It's the absolute core of value investing. A wonderful company can be a terrible investment if you overpay for it. So what does the price tag say? Well, one key indicator is the price-to-earnings ratio. ARM's currently sits at a staggering 3.13. To put that in perspective, the average for the S&P 500 is around 25. The market is paying a colossal premium, betting on just enormous future growth. And here is where our investigation comes to a head. On the left, we have the market price, what you'd pay today. On the right is the fair value, an estimate of its worth based on its projected future cash flows. And the gap between them is, well, it's immense. This results in a margin of safety of negative 498%. Now, a value investor like Buffett looks for a positive margin of safety, buying a dollar's worth of business for 50 cents, for example. Here, the situation is completely reversed. You're being asked to pay nearly $5 for $1 worth of calculated value. So after following all the clues, it's time to close the case. Let's put all our findings together into a final report card. And here is our case report. The business quality is excellent. Its financial soundness is rock solid with zero debt, And the growth story is positive, especially on the revenue side. But the price tag, it's extremely high and seems completely disconnected from the calculated fair value. And that leaves us with the ultimate question every investor has to answer. Our investigation uncovered a fantastic business attached to a stratospheric price tag. The final question is simple, but the answer isn't. For a truly great company, is any price too high?